Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. Thanks for joining me. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May. Cameron, 20-plus year veteran in the financial markets. He's out there to help answer your questions. Thanks to all of you who are joining me either here live or in the recorded version. If you're here live, go ahead and ask your questions right there in the chat. Cameron will help out with that. I'll try to keep an eye over there as well. If you're watching this in the recorded version, leave a comment for us in the description page in that comment section. We'd love to have those comments, and we'll answer those as best we can. Again, you can follow me. You can follow Cameron on X at Ben Watson CS, at Cameron May CS. And, you know, it has been an interesting week or so. We've seen a bit of a turnaround in the market. We've seen some sideways movement now going into the potential for next week. So let's see how this plays itself out in the index market, specifically with index options. I've got a couple of things that I want to do today. I want to manage our 14-7 strategy that we've been talking about, number one. Number two, I want to take a look at the possibility of using that 14-7 as a vehicle to get us to a trade that we haven't yet done in this particular webcast, a strategy that we haven't really talked about, and that's an iron condor. And then three, I want to take a look at maybe playing a longer term trend using index options, using something like a diagonal spread. So we're going to explore those three ideas here today. A couple of quick reminders, though, and housekeeping items that we need to take care of before we get started here. Remember that everything that we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular strategy or symbol or anything else. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions, transaction costs. Remember also that spread trading needs to be done in a margin account. Now, American style short options can be assigned at any time up to expiration, regardless of where they are. We're primarily focusing on European style options that don't allow exercise until expiration. So we'll point that out. We'll talk about some of those considerations along the way. Now, we're going to be using the Thinkorswim desktop software platform. It is not a guaranteed future success, but is a great learning environment and sandbox to experiment in. Just be aware as you move your trading from paper trading to live trading that some things change. So we'll be aware of those things. Remember that investing involves risk, including the loss of principal. Any way that we look at the market, whether it's technical analysis, probability analysis, fundamental analysis, those are theoretical in nature. None of those are guaranteed as to what the market might do. Also, when we talk about stop orders, which we might do in this particular discussion, remember that stop orders do not guarantee the execution price, simply the activation price. And in the event of a stop limit order, there is the potential that the order gets gapped around and does not fill at all. So, again, thank you for joining today. Some of you I've met in person in some of our live events. Some I have not yet. It's great to meet all of you when we're out there at those live events. So let's talk a little bit about where we're headed. We're going to talk about index options. We're going to talk about some strategies. And we're going to look at examples on the Thinkorswim desktop software platform. So let's do that right now. Let's jump out to the Thinkorswim desktop software platform. And again, you've got Cameron May out there in the chat helping to answer those questions. While we make this switch over to the Thinkorswim platform, I'm going to quickly remind you to click on that subscribe button down at the bottom of the page if you have not done so already. Don't unsubscribe yourself by clicking it again if you've already done it. But if you haven't, if you're brand new, welcome, of course, and click on that subscribe button right down there at the bottom of the page. Also, if you happen to like this webcast, click on that like button. That's like applause. We like to hear that as well. So let's talk about what's going on with the indexes, and then I'm going to roll into some of these questions. So, Bob, great question. We're going to talk about that. We're gonna get into some of those concepts of this in this discussion. So here's the thing: taking a look at the SPX, we've seen a change in the last little while, right? So we've seen this kind of intermediate term downtrend. I know Cameron's talked a lot about this. Kevin Horner's talked a lot about this in the Trader Talks webcast, the first thing that we do in the morning, and really kind of seeing that 10% plus move to the downside as kind of that corrective move. Now we've seen a reversal, and we see that coincident to the change in the RSI. So sentiment starting to make that move back to the upside, starting to see that push. Now here we are in the last couple of trading sessions, right? The last couple of days, kind of hovering right at this 200 period moving average. That suggests a little bit of uncertainty, or if not uncertainty, at least equilibrium, some balance in between buyers and sellers pushing prices higher. And the fact that the RSI, that relative strength index, is kind of going sideways over the last couple of days would also suggest kind of that sideways view, that sideways movement. Now, I would argue that last week or the week prior, that was a Fed meeting that was creating that kind of sideways move. You're right, Ricebird. It doesn't seem to want to fly a lot higher here above this 200 period moving average. And one of the reasons why might very well be, and again, this is simply correlation, not necessarily causation, and also kind of a post hoc ergo propter hoc. After this, therefore, because of this. But it doesn't necessarily have to be. That coming up next Wednesday, a week from today, we have that kind of tariff, administration-imposed tariff deadline. Perhaps theoretically, seeing a little bit more clarity in that, in the tariff situation. So what I'm going to do is I'm actually going to grab our horizontal line tool here, and that's this one right here. So that's our price level. This is our time level, and I'm going to come to 4.2, and I'm just going to click, and we'll just set that line in place on 4.2, right? So there's that line. And, not that that's a wall there, but that is kind of that demarcation of where we might see that movement, right? So it may very well be that the SPX, which is the broad market, kind of stays where it is until we get to that level, kind of sitting, hovering right around the 200 period moving average. If we switch over to the NASDAQ, we see the same kind of thing, although I'm starting to see maybe a little bit more weakness here in the NASDAQ, the RSI rolling over a little bit more. That bounce down from the 200. We get a little bit of a gap up and a sell-off today as some of those technology names kind of roll out in this index. And then the Russell 2000 well below the 200 period moving average. And coming off on the right-hand side here, we see a stronger RSI to the upside, but a little bit weaker movement today. A decided kind of hook to the downside on this right-hand side of the RSI, corresponding with this pullback. Now, is it making a bear flag yet? Not necessarily. We might be looking for, if you're looking for a bear flag type move, close below the low of the high day, right? And that might be here about this 2080 or 2074 mark, right? Let's do the same thing. Let's put that time hash mark here, 4.2. There it is right there. We'll just kind of click. There's 4.2. We'll put it right there so that we can see where that is and how far over the horizon it is. Okay. So there's a couple of things that I want to look at from this particular standpoint in terms of these major market indices. And we're not going to stretch too far afield from these today, simply because this is kind of where it seems as if not necessarily all the action, but all of the focus is in this particular case. So the two premises that I'm going to go with are, if tariffs are imposed, that it's going to have a significant impact on the Russell 2000, on those small caps. It's going to come home to roost in some of those small caps that are less able, perhaps, to pass on tariff impacts and kind of absorb those into their perspective, and also having a harder time perhaps passing those on to consumers. So who's going to get squeezed in the middle? It's going to be the small cap companies and their revenues and their margins, right? So from that perspective, we're going to take a look at a bit more bearish tone on the Russell 2000. But before we get to that, I want to come back to that SPX, and I want to take a look at the strategy that we have been using. And the strategy that we've been talking about for some time is when the SPX is above the 200 period simple moving average, we've been selling put spreads below. And when the SPX has been below the 200 period moving average, we've been selling call spreads, right? So above the 200, selling put spreads. Below the 200, selling call spreads, trading that oppositional movement, right? The expectation being that the price of the index is going to stay where we're not selling the vertical spread. And what we've been doing, and for those of you who may be brand new to this, is I'm going to go over here to my monitor tab, and I'm going to open up this particular strategy. We've been selling the call spread or the put spread at 14 days to go until expiration, and we've been buying it back at 7 days to go until expiration. And the reason for that perspective, and to go back to Bob Epic Small Steps question here, one of the reasons why we've been doing it this way is the premise, right? This presumption that an out of the money option, by the way, I'm just going to preface this here really quickly and say some of the things that we're going to talk about in this particular concept are more advanced concepts when it comes to option Greeks. If you don't have a good understanding of Greeks, or if you want to go back and review after we talk about this, go back to our Getting Started with Options series. I'm going to ask Cameron to put the playlist link out there in the chat so that you can go back and you can review those concepts. But here's the thing. So the presumption of an at the money option, I'm going to just label this ATM, an at the money option. The time decay presumption of an at the money option is this, that as we get closer to expiration, the perceived rate or the sensitivity to time decay increases, right? As we get closer to expiration. And so we're looking at selling at 14 and buying back at 7, right? So if this were the at the money option, that'd be great on our short leg. We're capturing that, working in our favor on the short leg as the driver of the trade, but that's also working against our back leg a little bit too. So we kind of balance that. But here's the nature of the options that we're selling. And since we are selling a short term and then buying it back closer to expiration, but not at expiration, we're not holding it all the way through expiration, something's changed here a little bit. And here's the presumption. Let me grab my magic marker once again. And we'll kind of talk through this. So we're selling these vertical spreads in our 14 days to go until expiration time frame at the out of the money position. So we're assuming that these options are going to be OT out of the money. So here's what changes is the time decay curve on an out of the money option, same setup, right? This is price versus time. There's expiration. But the premise is that an out of the money option, long or short, is impacted by time decay more substantially in the front third of its lifespan than it is on the last 2/3, right? So what happens is that curve, instead of looking like that logarithmic curve that we're normally used to seeing, almost inverts from that, right? So the majority of that time decay comes at the beginning. So if this is 14 days and this is 7 days to go until expiration, selling here and then buying back here means that we're capturing the majority of the time decay, as opposed to being stuck kind of in that slower time decay curve of an at the money option, which is all well and good, right? Until we get stock price movement. Now, delta is going to be a bigger directional, it's going to be a bigger influence on our option price, right? Delta is almost always going to be the biggest influence, unless we're talking about a deep out of the money or deep in the money option. Delta is almost always going to be a bigger influence, net influence in our trade. but we're selling way out of the money. So Delta's going to have a smaller impact until price moves deeper, so that this position the one that we sell gets closer to the at the money position. Then Delta significantly increases, Gamma significantly increases, and Theta kind of stays slower. So we're getting ourselves into a situation now. Let's take a look at what's going on in this particular trade. So the trade that we're in right now, I'm going to close this down. Hopefully that was maybe a little bit helpful in kind of explaining the decay scenario. But here's what we're going to look at. So this is our last one that we did. And we sold it 14 days to go until expiration. We sold the 58.90 call because remember, it was it was below the 200 period moving average. So we were selling call spreads above where the market was. We sold the 58.90 and we bought the 5900, 10 point wide. We brought in $1.20. The expectation being that as the market continued to move down, it would move further away from this. It would put this spread cheaper and cheaper, make that spread cheaper and cheaper. We could buy it back for less 14 days later, or 7 days later. Well, here we are 7 days later, and the market's moved back up. It's sitting right about the 200 period moving average. It's come back up, and now what's happened is also we've seen kind of a little bit of an overall increase in volatility, even though volatility has come back just a bit. Now the spread that we sold for $1.20 is now trading for $1.40, kind of bouncing back and forth, right? So Jerry, price to delta move was greater than time decay. Yeah, because let's look at the chart. Let's go back to the chart, and the chart that I'm going to change this to is our let's see, where is it? There it is, index options grid for the SPX. And you remember what we were doing is, if we look back 7 days ago, right? That was the 19th. That was right here. When we sold this spread, here's where the SPX was. It was down here, right? It was right down here. And that's where we sold that spread. Now, where has the market moved to? Well, the market's moved from there up to here. So what's happened is this spread that we sold has gotten closer to that at the money strike, right? So this was about a 15-cent delta, right? That was about a 15-cent delta. We used this probability of expiring curve as a means to project where we were going to sell that option. Let's go back to the trade tab here really quickly for the SPX, and let's look at where that delta is for the one that we sold, for the call that we sold. So we're going to scroll down and we're going to see where that delta is. I'm probably going to have to add a few more strikes because, to be fair, it's still out of the money, right? So we're going to scroll down. We're going to see the one that we sold originally. We're short this one. It's now at about a 12-cent delta. So it's not huge. It was maybe a little bit lower than that when we sold it, maybe the 10-cent delta or so. It's moved closer to that in the money position, closer to the at the money position. I mean, we're still, 15, 20 strikes away. Not huge, but the same thing, right? So, here's the scenario. Our premise has been, we sell it and we buy it back and we take what we get, right? Just kind of preserving the intellectual integrity of this particular trade, right? So I'm going to try to sell this, or buy this back, if we can buy it back for even. So I'm going to right click and I'm going to create a closing order, and I'm going to try to buy this back for even. If we can buy it back for what we brought in for it to begin with, $1.20 in this particular case, right? You can click on confirm and send, read through the order, make sure that that's what we want, and we're going to try to get that. And we'll see, we might get in that movement around while we're talking, we might get that trade to go off and close that vertical spread down, okay? Now, we could hold on to it. We could hold on to it until the end of the day. That's fine too. The only time that you and I have together is right now. So we're going to try to get that to close right now. Now, here's the thing. I want to talk through this and see what you guys think, okay? So I'm going to put on here, I've got the 50 period moving average. Actually, let's see. Let's put this on. I'm going to move this side open a little bit. So we're going to click on maximize sell. And that's the 30. I'm going to change that one, that moving average, to the 200, because that was our kind of line of demarcation, right? That was our indicator that told us yes above or no below. So there we go. Now we're going to click that, and that's going to be our 200. So what we can see is that if we bring this back to our grid, and I'll share this grid again, I've shared it, it's in the description, but I'll share it again. We can see that price is right at the 200 period moving average. And our toggle was, remember, above the 200, we sell put spreads because it has a bearish expectation. Below the 200, we sell call spreads because it has a bearish expectation. Okay, we just sold a call spread. Here we are, 14 days to go until expiration, which is the tariff deadline time horizon anyway. 14 days from now, actually 7 days from now. So if we sell 14 and buy back 7, that's going to be next week. So we're kind of sitting at the 200 period moving average. So what do? Ding! Wiley's got it. Wiley gets the door prize for today. There is no door prize, but Wiley gets it because Wiley came up with this. Should we compare this strategy to doing an iron condor? Because here we are sitting right at the 200. So do we? And look, dude, we went out at $1.20, right? We bought that back for $1.20. Cool. We went out at even. We didn't lose. We didn't win on that trade. So here we are. We're sitting right at the moving average. This is kind of that Bob Seger trade, right? Remember the song where he talks about being on the continental divide and you can go east or you can go west. It's all up to him. We don't know which way this is going. So it's also like the old joke, right? You can flip the coin and you can land on heads, you can land on tails, or the coin could end up on its edge. Well, we kind of have the coin sitting on its edge at this particular point, right? It's sitting right at the 200 period moving average. So let's think about how we might accomplish this in selling two vertical spreads. We'll sell a call spread at the 1 standard deviation line. We'll sell a put spread at the 1 standard deviation line. We'll turn this into an iron condor, and we'll see which one works. So I think this still preserves the intellectual integrity of our experiment, the 14.7. We're just going to do the same thing. So we're going to go to the trade tab, and we're going to open up our chain here. We're going to go to the 9 April expiration. That's 14 days to go until expiration, 9 April. But now what we need to do is go back to that chart, and we need to zoom in, and we need to say, all right, fine. Where's our 9 April expiration? Because that's where we're going to look for that 1 standard deviation. We know that we're going to get out of the trade next week. So we're looking for it right here, right? And right here. So we're pretty darn close there. And you can see how this is kind of cheating one direction or the other. So we're going to go to that's where we're going to buy it back. And so we're going to say, all right, fine. Where are we? Right there. And where are we? Right there. So we're going to be looking at the 5,900 short strike on the call side. And we're going to be looking at about the, let's call it the 56, probably 56.15. So here's what we're going to do. I'm just going to put this into my scratch pad here. 5,900 call. And we said 56.15 put. Those are going to be our short strikes, right? Yeah. You could, Jerry, you might shorten your time period. You might shorten that moving average to maybe the 50 period to be the toggle, right? Good idea. Yeah, and so this will help us to stay out. We haven't been staying out of important events. We've traded this through the Fed meeting. We've traded it through earnings announcements. We're going to trade it through the tariff here as well. So let's do this. Let's construct this trade. So this would be an iron condor on an index. Remember, this is a European style index, so we don't have early assignment risk. So we're simply capturing a wide range here of potential movement. We're giving the index a lot of room to potentially move. So let's go to the trade tab for the 9 April expiration. We know that we're looking at the 50, we said on the put side. Let me bring this out in my notes here. 56.15. Let's build the put side first. That's just kind of my habit. So we're going to go to the 56.15. which is about the 24-cent delta, which with implied volatility being where it is, that's kind of where it puts us in terms of that delta. So I'm going to sell the 56.15 and I'm going to buy the 56.05. Sell the 56.15 and buy the 56.05. So we've got a 10-point wide vertical spread, bringing in $1.20, actually $2 on this side. Implied volatility has kind of juiced this up a little bit on the put side for sure. And you can see that it's kind of bouncing back and forth between about $2 and about $1.30. That's typical of a day where prices are moving around a little bit. Max theoretical loss in this trade. So for those that were asking about position size, think about this. We still have a $15 or a $10 wide vertical spread, regardless of the number on this vertical spread, right? The strike price or the strike price number. We still have a 10-point wide spread. So bringing in $2 against a 10-point wide spread gives us about a $7 or $8 potential maximum loss. But watch this. And so from a position sizing standpoint, from a buying power effect, just because it's a big index, but we're trading the options doesn't mean that that risk becomes outlandish, right? We're still paying attention to it and it's still important, but we manage it as a spread, right? I mean, this is a spread and that's what helps us define this risk. Oh, also, and remember, it doesn't have early assignment risk. So from a short vertical spread, that could be a potential advantage. Now, let's build the other side of this trade. So I'm going to bring this back down and we're going to go to we said the 50, what did we say? The 5,900. So we're going to go to the 5,900. So we'll scroll down here. We'll go to the 5,900. There's the 5,900. And that's about the 19-cent delta. So on the call side, so that tells me that there's a little bit more put skew, meaning there's more activity going on in the puts. There's more buying going on in those puts. They're more expensive. They're juicier. And that's indicative potentially of the mood of protecting against those downsides, right? This is an institutional product when it comes to protection. Institutions may use SPX puts to protect long stock portfolios. So there's a bit of put skew going on here. And we can see that simply because of the kind of equidistant, the one standard deviation strikes having different deltas and different prices. So here's the 5,900, and we're going to sell that 5,900. I'm still holding my control key down, and I'm going to buy the 5,910, so 10-point wide vertical spread. So for the whole spread, right? For the whole spread, 10 points wide on either side. Here's the theory behind an iron condor. If you're not familiar with an iron condor, we've got lots of resources in our webcasts, right? So on a vertical spread, about 30%, sometimes traders will use, John, about 30% of the spread width as a maximum gain. On something like an iron condor, some traders will look for less than 50% of the spread width. So in this particular case, we go to confirm and send, and we see that our maximum theoretical gain in this case is $4.15. And our max loss in the trade isn't $8 like it was with the single vertical spread. It's now reduced the maximum loss to the $10 wide spread on either side minus the total credit that we're bringing in. So it reduces our max loss to $5.85 in this case, right? So it brings our max loss down, changes our buying power, reduces our buying power impact. Nice to meet you as well, Priya. And now gives us that perspective of saying, hey, cool. We're bringing in a little bit more premium, but there is the potential. We've got the possibility that one side or the other could be threatened. Now, the thing about it is they're not going to be threatened at the same time because at expiration or when we sell this back, the price of the stock isn't going to be both above our call vertical and below our put vertical. It could be in the middle. It could be in the middle of one side or the other, but simultaneously, I mean, look, my wife is probably the only person that I know that can be in two places at once. I know a couple of other people, but my wife does this on a regular basis when she's doing stuff. She's phenomenal. She can be in two places at once. But I know for a fact that the SPX cannot, at the same time, at the same point in time, cannot be at two places at once. It can't be both above our call vertical and below at the same time our put vertical. It's got to be one place or the other, right? So that's what kind of creates some of the desirability of an iron condor. And again, not a recommendation, simply a description of the strategy, right? So here's what we're going to do. We're going to put this in our index options weekly. We're going to try to bring in a little bit more premium. And the reason that we're doing it this way, the reason we're doing this as an iron condor is because we don't have a definitive of whether or not the SPX is above or below the 200 period simple moving average, right? Now, Ricebird asks a great question. So I'm going to go ahead and fire this off. I'm going to read through the order, make sure I'm aware of that, any of the transaction costs, and we're going to go ahead and we're going to send that order off, and we'll see if we can get that iron condor filled. That's 4 legs. So you got to account for the fact that there are 4 transaction costs there. Okay. And we got it filled for 420. Cool. Okay. We brought in 420. Now, here's the thing, right? We could hedge this iron condor one direction or the other, right? We could skew it one way or the other, or kind of cheat it more bullishly or more bearishly, depending on how we selected those strikes. And if we had an expectation that the SPX was going to trend in those 14 days, then yeah, we could cheat it one side or the other. But let's go to the Analyze tab here really quickly, and let's go to the SPX. And what we're going to do is we're going to look at our SPX position here. We're going to take all of these off. I'm just going to show positions and not these simulated trades. Okay. And so here's our iron condor, and here's what that looks like. Okay. Here's what our iron condor looks like. I've got to kind of skew this around a little bit so that we can see what this iron condor is going to look like. Okay. So I'm going to take those off and that one off. And here's our iron condor. Okay. So this is the characteristic risk profile graph of an iron condor. And we can do this. We can set our slices to break even. And there's the range that we expect the price of the index to stay in, right? And so we're expecting neutral movement. This is the type of trade that would expect that neutral movement, okay? So this is an iron condor on the SPX. Now, we're still going to do the same thing. We're going to still we're still going to take this off at 7 days, selling it at 14, 2 vertical spreads, selling it at 14, and we'll take it off on next Wednesday and then readjust. Okay. Yeah. So the return on the spread width, right? The amount of credit that we're bringing in on that short vertical. So these have all been $10 wide vertical spreads, right? And this is a $10 wide iron condor, one side or the other. So looking at about 30% premium against that $10 wide spread. So what's that? Now you could. We have not been placing exit orders in this particular strategy simply from the standpoint of saying, hey, we're not going to do that. So we're going to look at taking this off at 7 days to go until expiration. Again, there's a risk that one side or the other could get hit, but the most that we could lose is about $5 in the trade, right? That was our maximum theoretical loss. So the expectation is this is going to be cheaper when we go to buy it back next week. All right, that's one. Now the other, and I want to go back to our chart here really quickly, and I want to go to RUT. This is the Russell 2000. And remember what we said about the Russell 2000 is that it is moving to the downside, right? We're starting to see that bearish movement. Oh, by the way, I'm just going to say this. There's lots of great resources on iron condors and iron condor construction in the Trader Talks webcast channel. So I'm going to show you those resources here in just a minute. So if you are you want to review how we put that together, because we went through that pretty quickly, then I'm going to give you those resources to be able to do that. Now, here's what we're going to do is we're going to do a long put diagonal. Okay, a long put diagonal on this on the Russell 2000. The expectation being that we're going to see some continued downward movement. Now, we could do a long vertical spread, but we want to give ourselves a little bit more time to stay in this trade and perhaps roll the short leg down. So here's what we're going to do. And here's how we're going to create this long put diagonal. I'm going to go to the trade tab, and we've got an expectation. We've got an expectation that this might move down to this support level down around the 2020 mark, right? From where it is. So we're going to go to the trade tab. And now what we're going to do is we're going to split both expiration as well as we're going to split expiration, and we're going to split strike price, right? So we're going to go out a little bit longer in time. So in this particular case, I'm going to go out we'll go out 37 days here. That's almost 40 days, right? So we'll go out to the 2nd of May. And we're going to buy a long put option. Now, here's what we're going to do. We're going to buy this put option kind of where the market is right now, right? So it's right about the 2080 mark. And maybe even a little bit in the money here in this particular case. So maybe we come back and we buy one that is maybe at the 2090 mark, because we're at about 2083. We'll buy the 2090 strike. Now, that's going to be expensive, right? This is going to be a relatively expensive trade. This is not a butterfly like we did before, or a calendar like we did before, where it's a small cost to enter the trade. But the potential is that we can roll this against roll the short leg against this for a couple of different iterations. So we're going to buy that long put, the 2090 put. So we're going to simply say, fine, I'm going to click on the ask price for this 2090 put. This is bearish. This is a bearish expectation, right? And it's expensive, $55.60. So there's $5,560 per contract. But then what we're going to do is to create this as a diagonal spread. We're going to come back and we're going to go to, say, for instance, let's see where we've got maybe a little bit of elevated implied volatility. Let's go back here to the 20. So this one's got about 25% implied volatility. That's 9 days to go. That's the 4th of April. So there's a little bit elevated implied volatility there. And we're looking for this to move down to that 2020 strike. Okay. So here's what we're going to do. We're going to sell the 2020 strike. That's about a 22, 23 delta option. So we're creating directional sensitivity. We're shaving off a little bit of that extrinsic value in that long option that we bought. We're selling the 2020. We're creating this diagonal spread. This is a bearish put diagonal, long put diagonal. It's going to be expensive, right? We click on confirm and send. Our max theoretical cost in the trade and our max theoretical loss is $4,345, what we're putting into the trade. But let's put this on the Analyze tab here really quickly to see what this looks like, what this diagonal spread looks like. And let's take our long option off. And here's what this diagonal spread looks like. So it looks a little bit like our butterfly trade that we did, or it looks a little bit like our calendar trade that we did, but we've skewed this. So here's the thing. If this continues to go down, in this iteration of the trade, max theoretical gain comes if at expiration 9 days from now, the price of this index is right there at 2020. But if it goes down a lot, if we get a big move to the downside beyond that, then we're kind of locking in an area of some gain. Where we lose is if this starts to make a big run to the upside. And then the other thing to think about this, if we go back to the trade tab, is this, that if we've sold, let me grab my magic marker, we sold this one, we could then, we've got now, if we were to just do, say, for instance, like 7 days apart, we could go like here, and we could roll once, and we could like roll twice, and maybe roll 3 times, maybe 2, maybe 3 rolls that we could get out of this trade to sell against that long leg and reduce that cost. So our expectation here in this particular case is continued downside movement on the Russell 2000. So let's bring that order back up really quick. And let's see if we can get this filled and we'll put that trade on. So we're going to open up that limit. Now, this is, again, one that we're not going to necessarily manage, although we could. But the thing about it is we don't have early assignment risk. Even if we did, that would put us in a theoretical maximum gain scenario. So the key to this one is going to be following it through and managing it. So for those of you that were asking for longer-term trades because you don't trade those short-term trades that we've been doing, that's fine. This is a little bit longer perspective. We're at least going out till the 2nd of May. So I'm going to go ahead and click on confirm and send. We're going to read through this order, make sure that that's what we want. I'm going to put this in our index options group, and we're going to take advantage of that downside potential movement theoretically in the Russell 2000. Click on send. We'll fire that order off. We paid $43.50 for this long put diagonal, right? Okay. And here's the thing, the weekly, so Jorge asked a question, what about these weeklies? Why am I choosing weeklies instead of the regular expirations? Here's the thing about index options. Remember, these index options, because of demand, have expirations that are going to be on lots of different days. So I'm going to work to what makes the most sense from a implied volatility standpoint. I wanted to sell high implied volatility. I wanted to buy a little bit lower volatility because a rise in implied volatility in the back month is going to benefit that option. But the quicker decay of implied volatility in that front month, the one that we sold here, that's going to benefit us as well. So our expectation here is that we're going to see this move down to that 2020 mark or lower, right? Down to 2020 or lower, and see that continuation of that move to the downside. All right, so what we've done, guys, in putting all this together, let's go back to our monitor tab here really quickly and just kind of review this. We did two things at once. We managed our 14-7 strategy by closing at even our last iteration of the call spread on the SPX. And we added an iron condor, which isn't, I mean, we're still staying intellectually honest with that strategy, the 14-7. We're putting this on, selling it at 14 days to go until expiration. We're going to look at buying it back. It's already started to work in our favor here to the tune of about $5, and then it's kind of changing around a little bit. But the goal is here, because the 200 period moving average is kind of sitting right where the price of the index is, that this iron condor captures that range, gives us a bracket in which the index is likely to stay. Don't know for sure, but it might. And so we're doing both. We're doing both a call spread and doing a put spread. Then we took advantage of the potential for downside movement we saw technically in the Russell 2000. No guarantee of that. And we put on a relatively expensive. So our max theoretical loss here is relatively high. So this is a directional trade, which in order for us to be profitable in this trade, we're going to have to expect a couple of rolls and see that move. If it goes against us, we're going to look at taking the trade off or adjusting it. So we'll do that in subsequent classes. But we put on that long put diagonal. So let me do this. I'm going to pop back over here to our Trader Talks webcast page, and I'm going to show you one thing. Iron condors. IRON, condor. It is simply building blocks snapped together, right? Short vertical spreads snapped together. So here's a whole litany of webcasts that talk about iron condors, okay? Then the next one is the long diagonal. So I'm going to type in long diagonal. There you go. There's Cameron May talking about long diagonals. There's Cameron May talking about long diagonals. There's me talking about long diagonals. Brent Moore's talking about long diagonals. Barb Armstrong talking about long diagonals. Me, Brent, me again, Brent, me again, Cameron. So we've got lots of great resources for you to learn about those diagonal spreads. Hey, pick us up over here on the Schwab coaching site as well, schwab.com/coaching, and check out our in-person events calendar. We're going to be in Detroit in 2 weeks with our technical analysis and option strategies workshop. Join us up there in Detroit if you're up in that area, or you can travel to that area. We've also got some rooms still, I think, in the Dallas Advanced Options workshop coming up on the 25th and 26th. And then shortly thereafter, we're going to be in Denver for another technical. And we're going to be at the Gaylord, Colorado, which is a phenomenal hotel. Kevin Horner is going to be there at this one on May 2nd and May 3rd. So it's going to be a great time. Check out that webcast schedule and the live event schedule. So once again, that's what we did. We talked about vertical spreads. We talked about iron condors today. And we ran through a couple of examples. Guys, thanks so much for being here. Thanks to Cameron May for helping out. And of course, thanks to our great production staff as well for being here and keeping things on the rails. Well, maybe not on the rails, but at least keeping things going out the door. We appreciate that. Have a great day, everybody. We'll see you again very soon. Take care. Bye-bye.